Good morning and welcome to this Monday, May 1st, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we are starting a new trading week and a new month. For all of you go away in May, folks, it's time to go away. May 1st. I'm not a big fan of that, but if you are, just giving you the warning, it is May. Futures this morning to start off the month, we got Dow futures up 12, S&P 500 futures are down 2, NASDAQ futures down 18. Crude oil prices down about $1.70 a barrel, back to $75 a barrel. So we seem to be in a pretty wide range now from the upper 60s to the low 80s. And we're sitting almost squarely in that range right now at $75. U.S. 10-year Treasury yield up 2 basis points this morning. We're at 3.47%. Excuse me. And that yield, by the way, is also sitting kind of in the middle of a range. To the downside, we got pretty good support down at about 329, 330. To the upside, I'd be looking more around 360, maybe closer to 365. And here we are at 347. So sitting right in the middle there. But what's not sitting in the middle is the NASDAQ, which broke out last week. We saw the NASDAQ break to a high above its February high and above recent highs, and now challenging, or at least potentially on the verge of challenging the August high. The S&P 500, on the other hand, is right up against key resistance, has about another 10 points to go to hit that resistance. So let's take a look at that recap from Friday, see how we finished. So you can see the Dow Jones Industrial Average finished up 272 points at 34,098. Nice finish to clear earlier April highs. Still got a lot of work to do to get through the February and January high, and then ultimately back in the August high. But it was a start. We bounced off of, actually, we went a little bit below the 20-day moving average. That was probably the biggest takeaway for me last week, is that we saw potentially at least a short-term breakdown with the 20-day moving average giving way. But we rallied right back up on all of our major indices and went right back up above, at least on the 3 key ones that I like to follow, the Dow, the S&P, and the NASDAQ. S&P was up 34 on Friday, closing at 41.69. The high from over here in February was 41.79. So that's the 10 points that we have on the S&P. If we clear that level, then we'll be looking at the 4,300 level, which was the high back in August of 2022. NASDAQ, excuse me, there's your big move up 84 points, clearing on a closing basis. Actually, the NASDAQ 100 is the one I was watching, the QQQ, which had not closed above 321. The QQQ actually closed above 322 on Friday. So we did get a breakout. Whether or not we get confirmation and follow through, that remains to be seen, and that's what I'll be watching. One of the things I'll be watching today for sure. Mid caps also up 23, up about 1% on Friday. Small caps up 1%, 11 points. These are the two that are still struggling, though. We did see the mid caps climb back up above their 20-day. Small caps, however, still have about another 0.75% to get through that 20-day and start to repair some of the damage on the chart. Look at the AD lines, though. Even after the damage early last week, by Friday, our key indices all went back to new highs on the AD line. It's just telling us there's a lot of willing buyers in the afternoon. If you go back a ways, if you've studied the market, you should start to realize, if you haven't, that mornings a lot of times go opposite the actual direction of the market. So when the market's going down, sometimes you'll get a bounce in the morning, and then you get more selling in the afternoon. When markets are going up, you tend to see the market early in the morning struggling a little bit and then rallying into the end of the day. The AD lines are simply looking at where you close relative to where you traded that day. It ignores gaps. So it's not looking at where you were at yesterday's close. It looks only at today's action. Where did you close? versus where were you during the trading day. If you closed at the high end, all of the volume for that day, that's your multiplier, all the volume gets added. If you close at the low of the day, all the volume gets subtracted. If you close somewhere in the middle, well, if you close right in the middle, there'll be no change to the AD line. If you close somewhere between right in the middle and at the high, a portion of the volume will be added. And if you close below the middle point, then a portion of your volume would be subtracted. That's how the AD line works. It's very simple. Notice there are no numbers out here on the right-hand side because it's just a cumulative number. It just keeps adding or subtracting. So it's just telling you whether or not, based on this metric, are stocks being accumulated or distributed. I think it's a brilliant indicator. It's not my primary, but it's certainly a secondary that I like to follow. And all of these on the major indices, excuse me, still got these allergies. Anyway, all of the indices, even the mid caps, you can see ready to make another breakout on the AD line. The only one that's still struggling a little bit is small caps. Clearly, that's the worst performing of our major indices. And it's gotten better. You can see, even though we went down and nearly set a double bottom, you can see that AD line started to turn back up again. So maybe this will be a breakout. You know, I've highlighted many times over the last few weeks how these bottoms tend to form, or how they have formed on the small cap index. And you've got to wait for that trigger. The trigger is when you're downtrending and you get this reaction high. So far, I would say over the last year, almost every one of these lows have looked virtually identical. You go down pretty hard, you bounce back, and then you trade in some fashion between the low and that reaction high until you finally make a breakout here. And when you make that breakout, small caps tend to move up very quickly from that. That's been the recent history. So I'm on record. I said probably, I don't know, maybe a week or week and a half ago, something, I was looking for the small caps potentially to soar. And what I wanted to see was the clearance of the reaction high. We never quite got it, rolled back over, but notice we're holding the low. So this pattern, this bottoming pattern, in my opinion, remains in play, but we need to get that trigger. We need to get that breakout. That breakout now above that reaction high would also clear the 50-day moving average. So that would be something I would watch. And the reason I'm watching it is that if I get a breakout and I think I got a nice trend going, then you can start looking at leveraged ETFs. That's when I like to look for a leveraged ETF, either on a pullback to a major support level or on a breakout. Those are the two times that I really am interested in leveraged ETFs. Moving on to the sectors, 10 of the 11 sectors were up on Friday. Energy led the group, or led all the groups, up 1.5%, a little bit more than that. Financials up 1.2%, materials 1.17%, real estate up 1.15%. The only group that struggled on Friday and was down was the utilities group, and it was just down a fraction, down 0.14%. And if you look at the AD lines across the board, all five of these, energy is not at a high, financials not at a high, materials not at a high, real estate not at a high, utilities not at a high. But look at their AD lines. Every one of them right at highs, either just shy or making new highs. So even, and you look across here, none of these are the aggressive groups. So even in the areas that have underperformed in 2023, they're also showing strength in the afternoons. They're showing signs of accumulation. And in a secular bull market advance, the one thing you want is all groups to participate. You want leadership from the aggressive groups, but you want all groups going higher. You don't want it bifurcated where 3 aggressive groups are going up and all the others are going down. So it's important to see these groups really start to show some strength. And we're starting to see a little bit of that now, which is nice. All right, let's move on to the 10-year Treasury yield, get an update there. Currently not a whole lot of movement. We are up 2 basis points. We were up about 5 up at the 20-day moving average, which is at 3.496%. We've pulled back off of that a little bit. Short term, I think we're still in a downtrend here. Intermediate term, I think we're in a downtrend. Longer term, if we go back further in the year, I think you'll see we're clearly still in an uptrend. That's the way I see the 10-year Treasury yield right now. Growth stocks would certainly benefit by this yield continuing to drop, and I think it's going to over the course of the balance of the year. I'm not looking for the bottom just to drop out and have a huge decline, but I do expect that over time we're going to work our way down. I would not be surprised later this year, or maybe a year from now, if we're not all the way back down to 250, possibly lower, but I think 250 would be a pretty big low to try to negotiate. But if we get back down there, that's going to mean a lot higher valuation on growth stocks. And if the market begins to sense that the recession, if we have one, is going to be a very mild one and rates are coming down, I think we'll see a huge rally in not only growth stocks, but I think across the board. And I think it's going to be global. I don't think it's just going to be the U.S. We're kind of used to just the U.S. leading over the last 10, 12, 14 years. I think many of the international markets are starting to outperform the S&P 500, and I think that may continue for a while. So it's not just the U.S. I'm certainly no expert in international ETFs and funds. Can't be an expert on everything. It's hard to follow everything, but it's very simple to run relative strength lines. The S&P versus the DAX or the Shanghai Composite, anything. Emerging markets. I mean, that's all you need is a relative strength line to tell you what's outperforming what. So make sure, if you're interested in international stocks or international investments, pay attention to that relative strength versus the benchmark S&P. All right, speaking of the S&P, let's take a look at what's going on here. There were the last 2 days. So when when we go back down below the 20-day moving average, if you look over the course of the balance of this year, and really even since last May or June, we've had so many runs, the upside and downside. We've crossed the moving averages so many times. So when we crossed below last week, I know there are a lot of bears. I mean, hey, anytime that we move below the moving average, I'm a little bit more guarded than when we're above, because I know historically when we're trending and the market is above the 20-day moving average and the 20-day is above the 50-day, and you've got a PPO in positive territory, those are what you typically see when you're trending up. The opposite, the 20 below the 50, price below the 20, the PPO negative, that's what you tend to see when you're downtrending, like we were August, September, early October of last year. So it's okay to go back down, but you want to see, does the market rally? Do we come back up? Do we get back above the 20-day? Because we had a PPO that was positive. We've got the 20 above the 50. So moving back up in price is a really good thing, technically, because this is the configuration that we typically see during bull market advances. So the fact that we're back into this pattern gives us a better chance of moving higher than moving lower in the short term, in my opinion. Now, looking back, clearly 41.79 is the level. I can give you the exact number. The close was 41.7976. We got 10.28 points to get to that level. So if you see the S&P today up 11, we are in breakout territory above the February high. That would set us at about a 6.5 month high off of the October low, and would start to point us toward this October high, which was 43.0520. So that's the level you want to watch if we get through 41.79, 41.80. NASDAQ 100, this is the one I was talking about where we went back up through recent highs. Actually closed 13,245. The prior high that we were watching was 13,181 on the close and 13,180 on that open. So 13,181 was the level. We closed at 13,245. So we made the breakout. The last 3 days on this move up off the bottom, notice the volume picking back up again. Notice the AD line picking back up again. All of these things are very positive signals. The big enchilada that we still need to clear is that August high. And if we go out and we look at a weekly chart, this is where the August high comes into play. Because off of the top in November of 2021, you can see a move down in the NASDAQ here. Lower low, lower high, lower low, lower high, lower low, and nothing since. We haven't had a lower low, and we haven't had a lower high or a higher high. Well, so far, we do have a lower high. But in order to break the long-term downtrend of lower lows and lower highs, August, that high needs to be negotiated, needs to be cleared. And once that happens, if you're on the bearish side, I wish you the best of luck. I don't know what you're hanging on to at that point. So for me, that's just final confirmation. And if you're wondering why, well, if we haven't had the confirmation, why are you bullish? Well, I'm bullish because we're now up 22 or 23% off the low. The problem with waiting for a long-term chart to confirm is you miss the biggest part of the move. I've had plenty of signals telling me to go long here. Actually, I had them all the way back here. That was the first one. End of September, I said, hey, this is bottom 2.0. Your second chance. We ended up going down. I think we had 5 trading days on the S&P 500 that were below those 2 lows. That was it. There was all kinds of manipulation in the market pointing to Wall Street buying stocks while everyone else was selling. That's a major signal to me. That was one of the reasons we said to get out or to be very cautious going into 2022, because Wall Street was going up even though prices were going, or Wall Street was getting out. Wall Street firms were getting out while prices were going up. The month of December, when the S&P hit the final high, let me pull up the S&P here. When we went into that early part of January, right here, over the course of this month, defensive stocks were killing aggressive stocks. Wall Street firms were moving into aggressive stocks or moving into defensive stocks before we started moving lower. That was like the final straw. I could go into sentiment. I go in a lot of other things that called the top, that also helped call the bottom. Right now, all we're looking for is confirmation on the weekly chart of what we've already been seeing and talking about for the last 6 to 10, 11 months. A lot of folks still on the bearish side. When I called the initial bottom, it was almost a year ago, 3,600 and change. We're at 4,169 now. Still think this is a bear market. 500 points higher, 11 months later. Still think it's a bear market. Hey, anything's possible. I just don't see it. All right, question came in. Actually, a couple questions. But one question came in, Tom, how can you be bullish when the breadth on the NASDAQ is so poor? Now, there's a lot of different ways you can look at breadth. But the one that was mentioned in the question was the advanced decline line. Now, when you're looking at the advanced decline line here, this is just telling you every day how many shares were up versus down. So if it was a really good day in the market, a lot of times advancers outnumbered decliners by a big margin. And then same on the other side. We'd see the same thing going down. So the question was, why, if you look at the cumulative, and I said NASDAQ, I think, but this is the NYSE here. But the question is, if you look at the cumulative, which just simply adds the advancers minus the decliners, just adds it every day. So I want to show you what this looks like on the New York Stock Exchange. So I'm going to go down here and under type, instead of candlestick, I'm going to pull up cumulative. It's a cumulative chart. And so here, when you're looking at the NYSE, here's the bottom. This is the NYSE. And you can see the cumulative advanced decline goes down with price. And then this goes up, this goes up, this goes down. It's kind of following one another, right? And so when you're looking at this, you see the NYSE is still looking pretty good in terms of the cumulative advancers minus decliners. I mean, if you look at this over time, it's going up, kind of supports what's going on with the actual NYSE. Now let's look at the NASDAQ, because this is where the question came in. I'm going to do the same thing. So you can't really see what's going on here, right? But what if we pulled this up in cumulative form? And you're looking and you're seeing the NASDAQ going up. It's kind of following a little bit here, right? Looks like it's pretty much the same. And it goes down, this goes down. Now the NASDAQ's been going up, and yet the advanced decline has been going down. So the question came in, how can you be bullish? Or I'm kind of paraphrasing a little bit, but this is a breadth indicator, and it's showing that there's a lot more decliners than advancers throughout these last 3 months, while the NASDAQ moved up, and actually we saw with the NASDAQ 100 and the QQQ actually made a breakout. NASDAQ's right at the doorstep of a breakout. So what's this all about? What should we be worried about that? And on a 1-year chart, this doesn't really show you much, but I want you to go back. I'm going to go back 40 years on this. And I want you to look at this and tell me how many times you would have called a top on the NASDAQ if you had looked at this cumulative indicator, the advancers minus decliners. Here's a 40-year chart. The entire 1990s, we kept seeing this line go down, down, down. The last half of the 90s, when it was going crazy to the upside, this cumulative advanced decline was dropping big time. You would have missed the entire 1990 market rally. When you look at the last 10, 11 years, when we broke out on the S&P 500, I think that's kind of when we started the latest bull market. It was right around first quarter, second quarter, 2013. If you look at this, the first big move, 2014 into 2015, this advanced decliner was going down. When we were moving up through 2019, the advanced decline line, cumulative, was going down. It was only during this massive move that we saw any movement to the upside. And then look at 2021, 2022. It was going down. My point is that if you're going to use this cumulative line to determine whether or not you're going to be in the market or not, on the NASDAQ in particular, I wish you the best of luck. Hope it works out for you, because we're going down right now as we rebound. And there's a lot of technicians out there looking at this chart on a 1-year chart and saying, oh, wow, this is horrible. Breadth is awful if you look at the advanced decline line on the NASDAQ. What they don't do is do a little research and realize that the NASDAQ is made up of a lot of very, very small companies that kind of trade on their own. Most of those stocks just continue going down until they're out of existence. Many of them. And so it's rare for over an extended period of time for the NASDAQ, for all of the NASDAQ, not the big market cap leaders that actually matter, but you're looking at thousands. There's 33 or 3,500 companies on the NASDAQ. And quite honestly, there's probably only about 200 to 500 that really matter. All the other ones are very thinly traded. They're low market cap. They employ nowhere near the number of people that the bigger companies employ. They just don't matter. And yet, those who have to follow breadth will look at this and say, NASDAQ's doomed. Why? Because it's going up and breadth is going down. Bad breadth. The gingivitis of the stock market. Yeah, I'm not buying it. I do research. There's a whole lot more things important, in my opinion, than breadth. But I'll leave that. I'll just stop there on breadth. I could go on and on. The next question that came in was, Tom, you mentioned options expiration and max pain. Why does the Monday after options expiration, why is that the worst day in the market? And I'll just look at the S&P for now. Well, you can see, was it, well, I mean, I don't want to point out individual. The history of the stock market is that Mondays, the Monday after options expiration, we go down about 63% of the days. We only go up 37% of the days. Any day throughout the year, like if you just look back at all days in the stock market since 1950, 53% of them have been higher. If you look at only Mondays, all the Mondays, the number drops to 47. And if you only look at the Monday after options expiration, it drops to 37%. And so the question is, well, if max pain is all about options expiration and that ends on the Friday before that Monday, why is that Monday so weak? That Monday is so weak because not everybody closes out their option position on Friday. Many exercise. So let's say the market's been going up and you got a lot of in the money call premium. Anybody who sells those options has a big tax day. They got a tax bill coming up. But if they exercise and they buy the shares at that strike price, there's no tax bill. It lowers the basis of the cost of the stock. It just lowers the stock basis. You don't have any immediate tax implication. So a lot of options traders, if they're deep in the money, rather than take that profit and have a taxable event, will simply move into the stock. And what happens if they move into the stock? Market makers take the short position. So going into the Monday after options expiration, there's a lot more shares shorted by the market makers. And if market makers are shorting, which way do you think the market is likely to go? Lower. Now, not every week going into options expiration is an up week. If it's a down week, everything's opposite. Then you got in the money puts, folks exercise, and when they exercise, they short the stock. That means market makers go long. So the following week, market makers would actually have financial incentive to take it up. But the majority of the time, because the 11th to the 18th is a bullish period historically, and I'm talking about the 11th to the 18th of all calendar months since 1950, the tendency is for there to be more in the money calls. And I have said the Monday after options expiration is very, very likely triggered by the options world and options expiration. That's the reason. All right, chart of the day. Wanted to just show you, this is the one I featured in our EB Digest today. Red Rock Resorts. What I saw here, first of all, clearly a breakout above the prior high. That's great. Volume was 500,000, which if you look back, that's pretty good volume. Beautiful move to the upside. Volume trends have really picked up on this move. We're trending above the 20, which is above the 50. AD line new high. I mean, what is there not to like here? It's finally, after weakening against the gambling industry for 4 or 5 months, we're actually seeing nice relative strength for the last 2 months. So literally, there's not a whole lot wrong with this stock. But what I pointed out were two patterns. I don't know if you glanced at it and you see two patterns, but on this move to the upside, I see an inverse head and shoulder, left shoulder, neckline, double head there, right side of the neckline, right shoulder, breakout on volume. That confirms the breakout. The other pattern I see is just a top here and a top over here. Nice little rounded bottom cup. Pull back close to the 20-day. There's your handle. And at the end of the week, we got a breakout of the cup and handle. So if you're playing either one of these patterns, you want to be long. Both patterns, the inverse head and shoulder measures the 50-50, which would be about another 4% from where we are right now. But this cup, top of the cup, 48, down to the bottom, around 40, that measures up $8 to 56. So I think Red Rock Resorts looks like a great potential trade. And normally the way I like to trade these breakouts is I buy half on the breakout. And I save half just in case the market makers do their thing. Because sometimes you see these false breakouts and you'll get a big drop back down to 46, 45 and change, get that 20-day test. And what that does is chases a lot of these folks that buy the breakout, chases them out of the market. You buy at 48 or 49, the next day or a couple days later, you're back down at 45, 75, and you're like, wow, false breakout, I'm getting out. And I used to trade like that many years ago. And then I realized after journalizing my trades and realizing what the heck was happening is I was getting stopped out on these potential false breakouts. Stock was going down 20-day and then turning around and coming right back up again and then taking off. And I was getting whipsawed out of my positions. So now I take a different approach. And now when we get the breakout, I expect that we're going to keep going higher, but I'm no longer surprised if we come back down to the 20. In fact, I'll be ready to add to it when that happens. So anyway, that's just something to think about. Earnings, just want to go over a couple of these real quick. Not really a whole lot going on in terms of earnings this morning, but things will be picking up throughout the week, no doubt. This was one big one, though, that I wanted to mention. It's in the semi space, and we now have an open. So let's pull up the chart. And you can see big gap up today. It's up almost 4%. Can it get through the 20-day? Can it hold? If it can, this would be a big lift to some of the smaller semiconductor stocks, because some of the smaller semiconductor stocks have still been going down. NVIDIA might be near a high, but some of these others have not been performing well. And the entire semiconductor index came down to a key support level last week before reversing on Thursday and starting to show strength on Friday. You can see that on the semiconductor chart here. Well, earnings this morning, they beat $1.19 versus $1.09, got that gap up. But the question is, can we sustain it? Can we get through that 20 and hold on to it? That'll be a big test today. One other stock, GPN, I wanted to mention, and then we'll wrap up. GPN posted 240 versus 230. So they beat, but stock's been trending down and we gapped down with earnings. That is a key support level. We went down and tested around the 104 area earlier this morning, coming back up above the moving averages, then ultimately breaking out again above about 112.5, 113 is what you want to see with Global Payments. All right, that is it. I want to thank everybody for tuning in, especially thank you for joining our YouTube live stream. We'd love to build the presence here. So if you know other folks that you think would enjoy the show, let them know we're doing this. This is on Mondays and Wednesdays every week. I'll keep you posted, give you my thoughts on the market. Make sure you like our video below. That will help us, as well as subscribing to our channel. But that's it for me. Get a quick look at the market, see where we are, maybe around the flat line. Yeah, pretty much around the flat line. A little strength on the Dow, little weakness on the NASDAQ, flat on the S&P. Let's see where we go. It is the beginning of May, though. Historically, first week of May tends to be a very, very bullish week. We'll see if history plays a role this week. Have a great day, everybody. Happy trading.